So let's go over two examples of a discount market and two examples of a premium market, and I'll show you how to trade both of them. So in a discount market, what that basically is applying the concept of a market range to a market that is moving upwards, to a market that is trending upwards. So knowing that the market trends upwards is going to trend upwards and create series of swings, and those swings will have ranges, a start and an end point, and you can plot the equilibrium, you can plot the premium of that range, and you can now plot the discount of that range. Good job, guys. You made me proud up until this point. So now let's keep going. Now, because the market is moving upwards, institutions who are making money will be the institutions that are long positions. And because they are greedy, they are going to keep on pushing the market up as much as they can till they can't no more. And in the process of trying to do that, they want to buy at discount prices. Okay? So let us take the portion of the market that is bullish and we will consider that as a case study. All right. Let me make this clearer so you can see it. And this portion of the market, you can see, is moving or trending upwards. Now, if we drop to a lower time frame, because you can observe on the weekly time frame, if we go to the daily time frame for more data, for more information. Now, what you can see is a series of impulsive moves, right? So the daily time frame gives us more information. Let me get this out of our way now, and we can use these levels. So the daily time frame gives us more information. So let's go ahead and plot this, right? So let's look at the low of this candle. It's the beginning of the first impulsive swing that we can see. Low of this candle is 22.61, and price makes a high here, right? This is the high of that initial upwards move. The high is 51.40. Now, this concept of the market range will not show up every time. Sometimes the market may not pull back to all the way to the 50% level, the equilibrium. Sometimes price delivery may be so one-sided in the market that prices will not be able to get back to the 50% retracement levels. So we'll just continue to observe the trend. So let's try in this situation, okay? So we're gonna draw our first fib level from this low, start of the trend, to this high. And what do you see? Price doesn't retrace all the way back to 50% level before it continues. So that's cool. And we just continue we see that the trend continues upwards until it starts to make a sharp move down and eventually break structure here. We took out this low. Okay, so now let's try to plot this price chart. Let's try to plot this range, right? And you can see that between the low of 22.61 and the high of this candle, which is 105.58, a range is created. And what happens here? Price retraces all the way back to the 50% level, deeper into the discount of that area. Remember I told you that this whole region is a discount. So who's going to be camping here? Buyers, institutions that buy discounts. Remember I told you that institutions buy discounts. So institutions will be looking to buy once price reaches the equilibrium and deeper into the discount, right? So so institutions buy discounts. And you see what happens here. So when price reaches that bottom, you can see how price reacted. So once we saw the candles trending downwards, the second price touched equilibrium point of 48.86. Do you see how this candle has such a small body and the wick of this candles are so long? Same here. So now we have a candle with little volume, sorry, with little body, long wick. We see another down close candle following it. The down close candle that follows it cannot take out the low of the previous candle, cannot take out the high. It's inside of that range. Then we see an up close candle. Buyers take control. Boom, it's done, it's wrapped. At that point, if you're a seller in the market, you're getting cooked, and the trend is upwards. The trend has been upwards so far. So what does price do? Price shoots up again. Interesting, right? So let's continue down in this range. So we look again. Look at between this low and this high, right? Between this low and this high, if you take your Fibonacci tool and draw, plot from this low to this high, then another impulse swing, what do we get? What do you guys see? Do you see how this impulse swing was made upwards? And then price retraces. It comes all the way back to where? To equilibrium. Well, look at the price action now. Look at the candlesticks that occur when price touched equilibrium. Do you see how we first have this down close that doesn't touch equilibrium? The low of this down close is 86.21. Equilibrium is 83.44. So it doesn't touch it. Then the candle that does touch the down close opens at equilibrium. Actually, it opens at 83.43. Equilibrium is 83.44. And look at that reaction. It opens at equilibrium and then boom, upwards. See an up close candle, it closed above the previous candle's close. And then look at the candle that precedes it. Don't be deceived by the fact that this candle was a down close candle, was blue. The candle actually opened all the way at the high of 115. So this candle closed, the previous candle closed at 89, and then the next candle opened at 115. That's like a 30-point difference. It gapped up. So not surprisingly, we see price follow through with this another impulsive swing higher. Okay, so let us take this concept and continue to observe this chart, this daily chart of UPSC. So we see another, of that reaction, we see another impulsive swing here. So I want to plot another range, taking the low of this swing to the high of this swing. Do you see how price rallies from the low of this swing to this high, from 80.74 to 191.12, and then it begins to decline, and price declines, and price declines, and where does it decline to? It declines all the way back to where? 50% equilibrium. So this imbalance was created, and then because price wants to be balanced, price returned back to equilibrium. Buyers didn't stop there. What happens? Price goes even lower all the way to an optimal entry point. And then what happens after that? Lethargic move upwards. you see a sharp move upwards. Okay. Another part of the chart that is bullish on the weekly time frame that we're going to observe real quick is this section right here. When the trend changes, this is another example of okay, so let's take this. Let's consider this price action for a discount market. The first impulse swing that we have, taking this candle, we take from this low of this down close candle. The low of this down close candle is 12.53, all the way to the high of this up close. See how price moves up sharply? Boom. To the high of this down close, to the high of this up close is 26.35, and then we'll take that as a range, right? So we can draw a fib tool from marking from the low of that down close to this high. And what do you see? Price reacts sharply. See how price touches that high and then bounces off. So this candle, when this session was in play, this candle went all the way to the high, and when it reached that high, it reacted off. And what do we see from there? Down close candle. Down close candle followed by an up close. Up close just sweeps off the liquidity sitting on top of this down close, and then price goes lower. See a second leg down. So price rallies, reacts off of this high and dips into a discount of this equilibrium of this into a discount of this range. Okay? And price dips into the discount of this range, we see a lethargic move upwards. So we can plot this move now. You can plot this move now. This price creates another imbalance in this upswing, in this uptrend, this impulse swing here, and reaches this high, reacts off of it, trends downwards into a discount. So you can see that actually the first set of buyers came in when price reached the discount of that range. You can see by this up close candle that appeared here. But the buying pressure there was not enough. The buyers wanted to take it. There was more liquidity sitting under, and the algorithm decided to deliver price to those pools of liquidity. So we see price reach deeper into the discount of that range, into the bottom section of this range, and into this optimal trading point of 0.625 and 0.78. Price reaches into that level and see another reaction. Okay, so then you see another up move, impulse swing, creating another range. We can go ahead and plot. We'll take the high of that range, we'll take the low of that range, the low at 19.84, high at 49.3. Price from that high reaches into the discount, reaches into the equilibrium of that range, tries to react off of equilibrium. Told the buyers sitting there, because I told institutions buy at discounts, tries to react, couldn't, goes deeper into the discount of that range, then lethargic move up. Now this has created another impulse move. Okay, so we can go ahead and now look at. You can go ahead and do this. And what I basically did, I took the low of this swing and the high of this swing created. And it has marked out the 50% of that range. It has marked out the discount of that range. And we have marked out the optimal trade entry points in that discount of that range. So what happens here? Price reaches high, we declined all the way into 50%. Buyers try to buy. This is like the fourth example I'm showing you where price created a range, price retraced back into the 50%, and you saw buyers try to buy the 50%, but maybe for some reason there wasn't enough liquidity there, and price went deeper into the range. But consistently, you can see that buyers are always hitting at 50%. Price reaches deep into the market, into the optimal trade entry point. Now we see this order block. I'm not going to talk about order blocks in this series, but you can now see the market is now moving up. This is an obvious play to continue upwards, but that's a lesson for another time. So that's a discount market, guys.